All right, so we are going live today with the 5-day commercial real estate challenge. Want to thank you and welcome all you guys that have participated so far in the 5-day challenge and have stuck through it, have watched the replays, have just been involved. I gotten so far a lot of great feedback. A lot of people just really learning a lot of different things about commercial real estate, about why it's good to get into, how it compares from residential to commercial investing, and all the benefits involved. So far, we've had we're on day 4 out of 5 days, so we're almost there. So day 1, we went through your 1 year goals and how commercial real estate can get you to accomplish those goals. Number 2, we took a look at what's the ideal value add commercial real estate look like and what asset classes to go after. So, how to find a deal and what types of deals to be going after. Day 3, we went through how to fund your deal. So, you don't need to bring in all the capital to fund your real estate deal. There's different ways to do it between utilizing equity partners, utilizing lenders, private money. So, we went through that yesterday. And today, which is one of my favorites, is we're going to take a look at the top 3 exit strategies when it comes to exiting out of a commercial real estate deal, or strategies of how to recycle your funds, or different ways to reposition once you've completed your value add deal. So just starting with yesterday, can you guys, who wants to kind of share just something you got out of how to find a deal and what types of deals to go after? Was there anything new that you guys learned?
I think just having access to those websites, Crexy and Loop, and just knowing just kind of where to start. Because I think a lot of people are like, when they think commercial, they think big, huge business complexes or big, huge skyscrapers and things like that, and um, being able to narrow down exactly what it is that you're going to be focused on definitely helps out. And finding the deals is everything, and so having access to those websites definitely makes it easier. So that is something that helped me out.
Yeah, thanks for sharing, Austin. Yeah, and again, we talked about utilizing the commercial websites such as LoopNet, Crexy, and I did tell you guys these are mainly retail sites. It's harder to find the amazing deals on there, but they still can be found when you look at days on market and different ways you can filter through some of those deals. But just as good practice when you're beginning, you want to just go through those sites as much as possible to start understanding the lingo, the terminology, how a broker positions the deal with their broker packets and their pitch decks. And so you want to be able to read through those and start understanding what those look like. So yeah, and there's other paid sites you can utilize to get seller information, get seller data, to be able to reach out directly to owners of properties. All right, who else got something out of yesterday? Let's share a testimony here, Jeremy.
So I think again the best part that you mentioned is the education about seller financing. Um, Making those phone calls, finding that proper that unicorn, and um, really fingerprinting out the best way to capitalize on it. Um,
Mhm.
it keeps it clear from credit report bureaus, and um, it's a hands-on, direct process, and I think that it's a perfect way as a purchaser to buy the property. Come with little money down, and at the end of it, you can balloon it and pay it all off. And so,
Yeah.
so
Yeah, so when it comes to funding a deal, you know, utilizing seller financing as a way to get your foot in the door and having the seller actually finance the deal. And again, we talked about the art of the deal. And I think that's just so important because I love utilizing the art of the deal because it's something that you piece together creatively and you make all the different pieces work together for the buyer, for the seller, for all parties involved. And when you can piece that together properly, it's a beautiful picture. All right, so today on day 4, we're going to be talking about the 3 exit strategies. So regarding the art of the deal, you want to be able to know how to find it, you want to know how to fund it, and then you want to know what type of exit strategies you're going to have for that property. And it's nice to kind of be able to know that before going in, but the beauty of it is you can always pivot to a different exit strategy based off of market conditions. All right. So who has their workbooks? If you guys do not have your workbooks, there should be a link in the chat. If you do, let's go ahead. Let's show it. Awesome. All right. So starting from the top, you guys want to fill these out. If you paid for VIP, you get the workbook filled out for you, and I did the homework. So if not, let's just follow along with me. So starting from the top, the beauty of commercial real estate is that you can have different exit strategies based off of your goals. So, for those that are just newer that don't really know what the terminology exit strategy means, let me go ahead and define that. An exit strategy is in commercial real estate refers to the planned approach a property investor or owner takes to sell or dispose of their investment in order to realize a profit or achieve specific financial or strategic objectives. The choice of an exit strategy is influenced by various factors, including market conditions, property performance, and the investor's goals. So again, we talked about the end in mind. You know, when you know what you want for the end, you're able to reverse engineer it and have your plan from the beginning, and then you just follow the blueprints. So the first exit strategy we're going to talk about today, and I don't know if we can necessarily call this an exit strategy, but it's definitely a strategy when finding a deal. And this is called the wholesale method. Now, some people don't like talking about wholesaling real estate, but a lot of people do it out there. And if you can package a deal properly and sell it to another investor and give them an amazing amount of value, all parties can win. So it's doing it properly if you are going to choose this method. So, number 1, the wholesale method. Wholesaling is a commercial contract. Wholesaling a commercial contract is the process of assigning or selling the rights to purchase a commercial property to another party before the closing, often for a fee. So I'll just repeat that. Wholesaling a commercial contract is a process of assigning or selling the rights to purchase a commercial property to another party, another investor, before the closing, often for a fee. So there's some advantages to wholesaling, and this requires minimal money as you only need to supply the earnest money deposit. So, for example, if I go out and I find a particular deal, matches my buy criteria, we talked about having a buy box, matches it up. Let's say it's under seller financing, it's packaged, amazing. I put that property under contract. Once it's under contract, there's a time frame for due diligence and then a time frame for closing. So during that time frame, as I'm doing more due diligence for the property and going into the closing, I'm going to source another investor and just market it out to my investors and say, hey, I have this particular deal. I'm looking to assign this contract. If anybody's interested, let me know. And again, within the buy box that I formulate and that I go off of, most investors are going to be interested in something of that criteria. So another advantage of doing the wholesale method is there's less risk. as you are the value add deal finder and do not have to do the work and put much money into the deal, if any. So again, the reason there's less risk when you're wholesaling a deal is because you're essentially becoming the deal finder, and you're putting the deal together, packaging it together, and handing it to another investor that wants to go ahead and renovate the property, that wants to raise the rents, that wants it to bring it to market conditions. And they're also going to get a nice bump on that property after they do all that work. So you make larger immediate profits while leaving an even larger upside for the investor that you're assigning the deal to for a fee. So you're making a little piece of it. The investor that buys a deal from you, they're going to be making more because they're doing more of the work, and then everybody leaves happy. So let me give you guys an example of a wholesale method, just to kind of bring it into some terms. So let's say for my last year self-storage deal, me and my partners, we placed the deal under contract. And again, this was an amazing deal. So we placed this under contract for $200,000. It was actually a little less, but using round numbers. Let's say I didn't want to close on the deal, and I just said, okay, I have this amazing deal. I put earnest money down. I had it as refundable earnest money, and now I'm going through the due diligence period. I'm going to market this out to my investor pool. So typically, you'll do a refundable earnest money deposit or shoot for that with a 30-day due diligence period or inspection and 60 days to close after the inspection is approved. Now, again, everybody has to agree to these numbers. If you can get push that to 90 days, even better. But the more time you have, the better it is. Sometimes you might want to close, or the seller might want you to close within 45 days. Again, this is all negotiation. So, got it under contract for $200,000.
Hey, Chris, I think we lost you.
Yeah, Chris, I think we lost you on the volume. Is anybody in the chat?
Yeah, I sent it in the chat and it looks like Molly did as well. We'll see if he notices.
Okay.
I
Go
can
ahead
hear
for him
you
to
guys
go.
though.
Yeah, I can
Yeah,
hear you
I can
guys.
hear
I just
all you
can't
guys.
hear-
We just lost Chris's audio, it looks like.
You know what? This happened before. Like this happened yesterday too, I think. Let me call. I'll call him. Is he still going on a tangent?
I think he is, yeah.
Chris was on.
Calling Chris Rassam.
Oh,
Yeah, all right. Take a look here.
no, Chris, I can't hear you. Everybody else can hear me, but we just can't hear you.
Everybody that's on in the chat, we can hear. We just can't hear Chris.
All right, how about now? Can you hear me now?
Yeah,
Yeah.
yep, I can hear you.
Hey,
Yep,
welcome to
we're
the
back.
party, Chris.
Must have disconnected. I don't know. what
Welcome
happened.
back, man.
All right. And can you guys go ahead and speak? Let me make sure I can.
Testing.
Yeah, can you hear me?
Yeah,
Chris?
there we go. We're all back.
Hello.
All
We're
right.
back. We're back.
Welcome back to the party, Chris.
For some reason, the computer is just changing things here on me. All right. Sorry about that. Okay. Where did I leave off? I feel like I was.
Right at the beginning of the wholesale price process is where you're at. So you were giving us an example of wholesale that you were doing for 200 thou, and then that's kind of where it cut off after that.
All right. So pretty much I was going back to a wholesale example where, let's say if I took my last year's deal and we had it under contract for $200,000, and let's say the as is value price. So after that, we got a broker's value of opinion, which you can do that, or you can get an appraisal. But the broker value of opinion, which I got two of those, they told me, hey, your property as is today, again, this had storm damage, this had no tenants in there, so it definitely needed some work. But it was on 5 acres, it had multiple buildings. So the value of opinion as is was about 1.2 to 1.5 million dollars. And then the ARV, which is the after repair value, was $3.7 million. That's after all the improvements are done, after there's tenants, after there's revenue generated on the property. So we have a few numbers here, so you guys don't get too lost in this. We have the contract price. The example was 200,000. We have the as is value, which came in at 1.2. We'll just keep on the low numbers, 1.2 million. And then you have the ARV, which is the after repair value. When all said and done, it's going to be worth $3.7 million. So the gap between the 200,000, which we put it under contract for, and let's say $1.2 million, which is the as is value, ended up being $1 million spread. So if I said, hey, I don't want to purchase and close on this property, I don't want to do the heavy lifting and do the work, I just want to make a fee and hand this over to another investor, there's a price gap of essentially $1 million that I can play with. So if I offered that deal to another investor and said, hey, for $800,000, you can hop into this deal. It's worth 1.2 million. And after you put some money into it and get everything all said and done, the property is worth $3.7 million. I mean, who here as an investor would actually think that's a pretty good deal? So yeah, and again, this was a unicorn deal. So, but just so you guys can kind of wrap your minds around it. So if I said, hey, I'm going to sell it to an investor at 800,000. I have it under contract for 200. I'm assigning that contract to the investor, and I'm going to make a $600,000 fee and just walk and be done. The investor, he's going to put 500,000 into it. So his 800 plus 500,000, he's in it for 1.3 million. When all said and done, his valuation is going to be 3.7 million when he sells it, resulting in a profit and $2.4 million for that person. So he's getting a really good profit because he's actually taken the time to do the repairs, to do everything needed. But if I just say, hey, I got this, within a few months or within 6 months of my journey, and made $600,000 assigning this contract to another investor, I mean, who here would be excited about that deal? Not a bad deal, huh? And again, I'm going to give you guys another example. So let's take a more conservative example. The one I just showed you, that was something that we had last year, but we held it. And again, I'll show you the different exit strategies and why we actually wanted to go through with holding it. But wholesale method example number 2. So let's try to do some easier numbers here. Let's say you find a property that's $1 million with a 10% cap rate. So again, you put a property under contract that's $1 million property, and the return rate on it is a 10% cap rate return. which is the, the return rate. So this means this property's net operating income, your bottom line, earns you $100,000 a year after expenses. So pretty good deal. And again, typically retail rates when it comes to cap rates or return rates are going to range from maybe 5 to 6% depending on the market. With market right now with higher interest rates, they're going a little higher, maybe around 7%, give or take. On a good market, they're usually averaging 5 to 6%. So if you find a property with a 10% cap rate return, that's a really good deal. So let's say you want to wholesale that deal. So you find an investor and assign the contract to them for 1.25 million, which is an 8% cap rate. So again, you take that $1 million property at a 10% cap rate and you say, hey, I'm going to sell this to another investor and assign it at 1.25 million at an 8% cap rate, because that's still a really good deal to another investor. They're still going to be able to add value and increase the value of that property. So in that example, you assign that for 1.250 million, you have it under contract for 1 million. What's your profit and takeaway on that deal? So $250,000 is your takeaway essentially for finding that deal, getting it under contract, and assigning it to another investor that wants to take that property to the next level. So again, essentially you're the deal finder, finding that deal, structuring it all, and being able to do all the due diligence, do the underwriting, know what the pro forma is, know what's involved in getting it to that pro forma number, and then positioning that for another investor that wants to do a buy and hold. So again, going a little more conservative on the numbers, if you take that same $1 million deal and you sold it at an 8.5% cap rate, which is a better deal for that investor, the sale price would be $1.76 million, which would result in a $176,000 profit for you. And for the investor buying it, let's say, hey, that property, once you reposition or you do, a little bit of work, is going to be worth 1.8 million. That investor ends up making about $600,000. And again, this is simplifying things. So either way, you just made $176,000 if you sold it, a little less, and he's still making a pretty good chunk of change with his reposition. So is this something that you guys can live with if you found one of these deals per year? What about one of these deals per quarter? So 4 deals per year. If you focused on getting one deal under contract every 3 months and selling that to an investor and making these larger 6-figure spreads, I mean, what would that do for you guys? So even if you made $100,000, $200,000, $300,000, $600,000 on one transaction, even if that was one a year, which we would shoot for 4, but even if that was one per year, how would that income help you and help your family? Who wants to chime in? What would you do?
Exponentially.
Yeah.
Exponentially. I mean, yeah. I mean, if you do one a quarter, I mean, I'd be able to buy a property without an issue right now in today's market for residential.
Mm-hmm.
So yeah, that would definitely be life changing for sure.
Yeah, who else? And again, there's the beauty of commercial is there are these larger spreads that can happen when you learn how to invest in commercial properties, learn how to structure the deals, learn how to find the deals, and whether you're going to take the whole property on yourself or bring on a partner or wholesale it and assign it to somebody else. I mean, there's just so much opportunity regardless of the exit strategy you choose. Austin, you're pretty familiar with commercial real estate. Do you think that it's doable for someone to assign a deal and make $100,000 on a commercial real estate deal?
Yeah, absolutely. I mean, I think that 100,000 on the lower end for some of the larger deals that are out there. If you can get a larger property and split it up or find ways, to subdivide it in a way and see the potential of what it could be, then $100,000 is easy. You could get multiple of that. And it's a fairly quick process that you can do this through. If you find the right buyers and you have the right people that are willing to invest in it, it can go pretty quick.
Hmm. Yeah. No, thanks for sharing. All right. So with that said, again, you can easily make these types of spreads with commercial real estate with, where you can take one transaction and you can easily make 6 to 7 figures of profit. When you hit 7 figures of profit, that means you're more than likely going to be able to hold that property and reposition it. Unless you're wholesaling 20 to 30 million dollar larger apartment deals, then you can actually get into 7 figure profits on those. But again, this is just to really expose you guys to the different ways that you can make money in commercial real estate. The the advantages with wholesaling is if you don't have a ton of capital to put into a deal, and if you don't want to have to manage a deal, if you bring in capital partners or investors, you don't want to be the person that manages it. You don't want to have to, do renovations. You don't want to have to do any bookkeeping or raising rents. If you just want to be in and out of these deals and transactions, then you're essentially going to be wholesaling your contracts out, which means you're going to be the deal finder. You're going to be making lots of calls. You're going to be, taking that package to investors and letting them buy that, letting them buy that deal from you. And I think if this is done properly and done right, it can be done in a good way. I think the thing to be careful of is you have some people that will wholesale or focus on wholesaling deals, but they will find any deal, anywhere, or they'll find another wholesaler and just pitch out that same deal. And it's called daisy chaining, which you don't want to get into daisy chaining deals. So there's also, if you're a buyer, ways to vet out a wholesaler by asking them certain questions. So if you work with a wholesaler, if somebody was a wholesaler and they came to me and said, Chris, I have this amazing deal, I want to, assign the contract to you. I'm going to ask them different questions. I'm going to ask them, hey, are you working directly with the seller? Is the contract in your name? Are you working with other wholesalers or other people on this deal? So you can find different red flags between them saying, yeah, I'm working directly with the seller, or, me and my partners are working on this and we're selling this, which could be a red flag because their partner might be this guy that they don't know that is the actual one that's wholesaling, that has that relationship with the seller. Does that make sense? All right. Give me a thumbs up. I still have you guys with me.
So
Awesome.
what about, Chris, what if you purchase a property and you get it under contract and you try to get the wholesale passed along, contract assigned, but in the due diligence period, you can't find somebody to take on that contract?
Yeah, and that's part of the risk that comes with wholesaling that you want to mitigate, and that's why I specifically mentioned that you want to have a refundable earnest money deposit. So if you have a refundable earnest money deposit, then if the deal falls through, you can get your earnest money back. And again, you have to be careful because you don't want to go out and get deals under contract and have them fall through. So you don't want to be known as that person. So that's why I say you have to find deals within the buy box that I would, position because it's all a formula. So if you have the right formula, the right buy box, if you have the right deal under contract, there's a lot of investors that will want that deal. If you're out and getting a retail deal and trying to wholesale that, no, you're just going to get a bad name for yourself. So it's really important on how you approach wholesaling, doing it, making sure you do it in a good way, because there's a lot of wholesalers, with bad names, I would say, out there. But you want to be professional. You want to make sure you have the right deal under contract, and you want to build your investor list so that when that type of deal comes along, you know that you have certain buyers that are buying those types of deals and that would jump on those particular deals. So also, if you have investors that are buyers, you can ask them, "Hey, what markets do you buy in? What is your buy box?" If an average investor will buy at a 7% cap rate or 7.5% cap rate with those value add items in there, then and if you find a deal that's a 9% cap rate deal, you make the spread on that, and again, everybody's happy. You have a potential buyer lined up. So again, this is giving you guys the 30,000 foot view. There's a lot more detailed things that if we were to work together, that we would go over when it comes to really specifically going out to market and how to do these things in a tactful way, in a professional way, and in a way where everybody ends up winning.
Hey, Chris, I think this question would kind of go for all properties and all types of deals and exit strategies, but what are some of the main things that you go into during your due diligence? So once you get a property under contract, you're under the clock to do your due diligence. So what are some of the main things you go after to look at?
Yeah, I mean, for me, it's really taking a look at. So, for example, if it was a self storage facility, what I want to know is first looking at the property. We want to get an inspection. We want to make sure there's nothing that's unknown repair wise. So a lot of times there's something called deferred maintenance, which means the owner deferred maintenance on certain items, and it could be the roof, it could be air condition, it could be certain things. Now, certain things would be known, but sometimes there's things that are unknown that pop up that can be a huge repair that'll affect the value of the property, which you would have to go back and renegotiate through the process of an inspection. You want to get an appraisal. You want to make sure that the property appraises at a certain value, because if you're trying to buy a deal at a better cap rate or better price, and all of a sudden you find out that $1 million deal, the market value is 1.1, then there's a problem there. So you want to look at the value. You also want to look at the market, the current rents and market rents. So you want to do your own due diligence. You want to look at facilities within a 3 mile radius, and you want to see what everybody's charging for rent and how does this facility's rent compare to the other facilities, because maybe a broker positioned this deal for you and their numbers are not accurate, or the owner positioned and the numbers are not accurate. Other things that I would want to look at is operating expenses. So going through all the operating expenses, making sure those are accurate numbers. Sometimes some things could be, not accurate when it comes to the operational expenses, and certain things are actually more expensive than what they have listed on paper. So there's just a variety of things to look at when it comes to due diligence. Also, what else would you typically look at on your deals?
So most of our deals are land deals, not existing properties. So, we go through title reports, go all through your altas, making sure easements, there's nothing encumbering on the property, looking at zoning laws, talking with the city, making sure, there's not a huge roadway going right through the property and you're going to lose half an acre, things like that that you need to look out for, which a lot of that stuff will show up in a title report, and going through all of the historical data to make sure that no one has, private access to it that you're not aware of. And then looking at your market rents in the area, and generally looking at your density of storage. So like a per capita base of how many square feet per capita on a self-storage base is something we look at, which is pretty important.
Yep.
Kind of a per capita basis, it shows you a demand of an area, if it's saturated or not saturated. And then if it's not saturated, probably want to build on it as long as the rates are there.
Yeah, no, all good information. And again, going into land deals, that's a whole nother topic for a whole nother day. But if you're first starting off in commercial real estate, I would stick to something that's already a cash flowing property before you start getting into things like land development, different things that require a little more. Again, we're trying to look for what are the safest investment types to get into, especially as a newer real estate investor. All right, so let's go ahead and move on in the workbook. We have number 2. So the second exit strategy, and this one is pretty straightforward, is going to be you buy, you reposition, and you sell it. Again, you buy, you reposition, and you sell. So this involves buying a property, adding the value to increase revenue, and then selling it for a higher sales price and generate a great profit. Typically, the turnaround time for something like this is going to be from 2 to 5 years. And again, this depends on how big the facility is, how much work it needs. It may not need a lot of work. A lot of times you can, if you want an easier way to get in, you just find a facility with under market rents. You can buy that, fix the under market rents, make them market. You can fix some of the marketing, just really light items, and then reposition that a lot faster than 2 or 3 years and make a profit. But again, we see the more work involved, the higher the profit is. So you can do more work, make more profits. You can do less work and still make some pretty decent profits and be safe. So this would require either your own capital or capital partners to fund the deal if you are going to buy, hold, reposition, and then have a sell off. So again, we talked about how to fund a deal yesterday. You're going to either fund it through capital partners giving away equity. You're going to fund it through hard money lender. You're going to fund it through traditional bank financing. The one thing that I love is there's a lot of great tax benefits throughout, which include using strategies such as cost segregation, depreciation, interest expenses, and you can also utilize a 1031 exchange upon a sale to not pay capital gain taxes and so much more. So there's huge tax benefits that most of you guys might not even know until you actually start getting into investing and having your own properties that you'll realize. So just to go off and go over a few of these tax benefits. So what is depreciation tax benefit? This is where investors can benefit from depreciation, which allows them to deduct a portion of the property's cost over time. So with land, it's not depreciable, but with the building and improvements, those are definitely depreciating assets. So each year you get to take a certain portion and just write it off as depreciation. What is cost segregation? So cost segregation is a strategy that involves identifying and reclassifying certain components of a property for accelerated depreciation. This can result in larger depreciation deductions in the earlier years of ownership. So a lot of people are starting to utilize cost segregation, which is where you hire a company to give you a cost segregation report, and they pretty much show all the different items for that property that can be that you can depreciate essentially in year one or the earlier years of the property. So you don't have to have like a 10, 15-year gap to depreciate those items. A huge benefit when it comes to commercial real estate. What are interest deductions? So for interest payments, they're mortgage interest payments on commercial real estate loans, and they're typically tax deductible. So if you have a loan, you're paying interest on it, you get to write off those interest expenses at the end of each year, which is why leveraging with real estate versus paying cash for real estate sometimes is a better way to go, because you can actually write off those interest expenses. So again, there's a lot of different tax benefits that come with investing in real estate. And again, that's why they say, hey, real estate investors don't pay taxes, because they utilize all these tax strategies so that they bring down their income levels where they're really not showing much income, yet they're still cash flowing these properties. Hopefully that's beneficial. All right. So three exit strategies. We're on the last one, number 3. We're going to talk about the Burr method. So some of you guys have heard about the Burr method, and I'm not talking about being cold. So this involves buying a property, adding value to it, and increasing the revenue, and then refinancing through traditional bank financing to pull out capital for further investments, allowing the investor to recycle their initial funds. This is my favorite method if done right. So, how do we define the Burr method? Number 1, first, there's the buy. Second, there's the rehab. Third, there's the rent or increasing of the rent or renting out the property. And last, there's the refinance. Sometimes I like to define this as buy, rehab, refinance, and repeat. So on the buy, you want to acquire a commercial property at a below market value, allowing for potential equity and profit upon completion of the strategy. So I told you guys, you make money on the buy. When you buy a property below market value, you've already made money equity wise on that property. Second is the rehab. So you want to go ahead and you're going to end up renovating or improving the property to increase its value. Sometimes this could be light things, sometimes it could be a little heavier. The goal is to make strategic enhancements that will attract tenants or buyers and justify a higher appraised value. So again, if you're changing the roof, if you're painting, if you're putting new garage doors, or if you're taking an apartment building and just renovating each unit that's outdated, you're adding a lot of value to that building, which calls for a higher appraisal value. You have the rent. If there's no tenants in place, you're going to want to place tenants in the property to generate rental income. Or if they're below market rates, you're going to want to raise the current rents to market rates, which again increases your revenue, which increases the value of your property. So securing stable and reliable tenants is crucial for the success of the strategy, as rental income helps support the financing and operational costs. One strategy too that I'll share with you guys when it comes to multifamily, which is automatically included in self-storage, is finding a property that has month-to-month tenants. So if you find, let's say, a 12 unit, 24 unit, 50 unit property, and the building is outdated, the units are outdated, all the tenants are month to month, you can make that a really huge value add play. And one way by doing that is ending up, as those tenants leave that month to month, or if you get rid of their lease, you clear out the building and then you renovate the whole building as a whole, all at one time. So this would be a major improvement project. But once you do that, you fill it up with new tenants. You have a higher monthly rate that you're charging, and all of a sudden that property is worth a lot more than what you purchase it for. So that's a good value of a value add property. The great thing with self-storage is that all of the contracts are already month to month. So if for any reason you need to clear the place out and renovate the place as a whole, you can do that pretty easily. Or you can just wait as each person leaves. You can renovate the unit one by one, and or bring in new tenants that are higher paying as each person leaves. So it gives you a little more flexibility. Now, for apartments, when you go to release an improved unit, you want to try to get 1 year lease commitments, because when you sell the property improved, it's better for the other investor if there are longer term leases in place. And the last part of this BRRRR method is, or one of the last, depending on how many R's you throw in there, is the refinance part. So after the property has been renovated, leased, and you've increased the value, all of a sudden that property is worth more, which you can go in and refinance and pull out the equity. So, for example, if you purchase a property for $1 million, and let's say you've put in $250,000 into it, so you got 1.25. After you finish those renovations, let's say it comes out to a value of $2 million. Now you go to the bank and says, "Hey bank, this property is worth $2 million. Will you lend me 75% worth of that money?" So who has a calculator? What is 75% of $2 million?
5,
What is it?
1.5 million.
1.5? Okay, so in that example, you're getting a new mortgage for 1.5 million, but they're giving you that 1.5 million back to you in your pocket. So you get to pull out 1.5 million. Now you have a mortgage on the property. You've put in 1.250 million. So you're actually taking out an extra $250,000 from what you've put in all into that property when you refinance it. So what this is called, and again, when you do that refinance, that extra $250,000 is tax free until you actually sell that whole property. So you don't pay taxes till it's sold, which is why you want to leave 25% equity and only take out 75% on a refinance. That way, when you do sell the property, you could take the 25% proceeds and use that for your tax bill. But in the meantime, you get to take that $250,000 and put that into your next project. Essentially, you're getting back $1.5 million you can put into your next project, but $250,000 is above what you initially invested, which is amazing. So what I love to call this is a zero basis deal that provides infinite returns. What I mean by zero basis is that even when I refinance, if I can get my initial capital back to me so that I'm at zero basis, $0 into it after, let's say, a refinance, everything else that I get is just an infinite return. Any cash flow that property produces is an infinite return. And that the value of that property is going to continue to increase year after year. So this is an amazing strategy that I personally love when going into a property, saying, okay, once we go ahead and renovate this property, we're going to refinance, pull out our initial funds. If we make more than our initial funds, then amazing. But even if I just get my initial funds back and I get to keep that property and cash flow it and let it increase in value, that's a huge win. And I think you guys should think that's a huge win too. Does that make sense? Yeah. Yeah. And again, this is why I love the creativity you can do when it comes to investing in real estate. So, try to wrap up here. Your end goals will determine your exit strategy. Your end goals will determine your exit strategy. Depending on what type of investor you are, what type of work you want to do, what type of role you want to play, will depend on the exit strategy that you want to choose when it comes to either wholesaling a property, buying, reposition, and just selling, or buying, reposition, refinancing, and then repeating that over and over again. So I think there's just some amazing ways to structure all of these deals that give you different ways to pivot, that give you different ways to change also as the market changes. But you can only change as the market changes in a good way if if you bought right. So again, profit is made on the buy. If you buy right, whether the market's going amazing or goes down, you still should be in a decent position depending on how you bought the property. All right, and that's the top 3 exit strategies for today that we're going to be going over, that we went over. I told you guys starting earlier in the week that I'm going to kind of give you guys an offer. If you guys would like to hear what I would like to offer out for 2024, give me a thumbs up if you guys want to hear what I'm looking to do for 2024. All right, so my offer is I'm looking for a select handful of new or experienced investors to be part of my partner mentorship program, which I can mentor using which I can show how to do these strategies in 2024 to get your first commercial real estate deal within 6 months of working with me. So again, I only want to have a select handful of mentors that I'm looking to work with as part of my partnership program in 2024 to start using these strategies, using these techniques, and getting out there and taking action. I'm looking for people that are just committed, that are go-getters, that really want to take action in 2024 and make that $100,000, $200,000, $500,000 on a deal, or hold a deal, reposition it, and just make it into something that can give you 7 figures of profit. So I'm going to be looking to intentionally invest my time and energy to help a select few that I choose to be a part of my mentorship program. I want this to be limited. I don't want to have too many people where I can't put the right time. I can't invest the right time into those individuals. So part of this is just to be transparent. This is not going to be free because my time is not free. So there's going to be a cost to work with me directly, one-on-one, teaching these strategies, helping you underwrite these deals, helping you negotiate, and getting you to the finish line of your first commercial real estate deal. So tomorrow I'm going to be sharing more with you in regards to a special limited offer that I'm going to offer the first few, if you join in by the end of the year, that are interested in getting involved and getting started in commercial real estate. So you guys don't want to miss out on what I have to offer tomorrow. And I think it's going to be something that you guys could potentially be interested in. And again, I'm only looking for people looking to take action. And, if you don't work with me, I would suggest work with somebody to get in the game. Doesn't have to be me. It can be anybody else. There's lots of great, amazing teachers out there. But my biggest thing is to take action. All right. So with that being said, for today, I'm going to release the live stream, and let's do a little Q&A for the guys on the live call.